Most traders are watching the same five stocks: Nvidia, Apple, Tesla, Amazon, Meta. The names that every financial news anchor mentions every single morning before they've had their second cup of coffee. And I get it. These are the biggest companies in the world. Combined market cap approaching $15 trillion. Of course, everyone's watching them. But here's what happens when everyone watches the same thing. Every piece of information about those five stocks is already priced in before most traders even log into their accounts. The edge is gone. The alpha is gone. And while everyone's staring at the same screen, something else is happening. A mid-cap stock, $60 range, not on any hot take list, not trending on financial Twitter, quietly went up 40% in 14 trading days. Not because of hype, not because of a meme, because the fundamentals changed, the technicals aligned, and institutional money moved. Systematically, quietly. Wall Street barely mentioned it. The algorithms that scan for momentum flagged it after the move was already halfway done. Most retail traders found out when they saw it in a "Stocks Making Big Moves Today" headline, when it was already up 30%. I'm Marcus. This is Black Bear Trading. Today we're breaking down the full move. The stock, the catalyst, the technical setup that made it identifiable before it happened, and the risk every single person buying this name right now is taking on whether they know it or not. Because the move is real. But so is the danger of chasing it. The company is Sprinklr. Ticker CXM. Enterprise Unified Customer Experience Management Software. Not the sexiest description in the world. But sexy doesn't make money in this market. Cash flow does. 3 weeks ago, Sprinklr reported earnings, and the headline numbers were good. Revenue came in at $211 million, beating consensus estimates by 11%. That's a clean beat. Guidance was raised for the second consecutive quarter. But here's the number that mattered. The number that the algorithms didn't pick up on fast enough. The number that institutional portfolio managers were waiting for. Free cash flow. Up 300% year over year. Let me say that again. Free cash flow. The money actually left over after running the business, up 300% in 1 year. When a company makes that kind of transition from cash-burning growth mode to generating real free cash flow, something fundamental changes about how it gets valued. Institutions don't just buy the revenue multiple anymore. They start thinking about it as a cash-generating asset. And that repricing happens fast. We saw it start on the after-hours session the night of earnings. Volume spiked immediately. By the following morning, the stock opened up 14%. Most people called that the move. They were wrong. Pull up the daily chart for CXM going back 8 months. What you're going to see is a classic descending wedge. From last September through to the earnings date, the stock was grinding lower. Lower highs, lower lows. The kind of price action that makes retail traders give up and move on. But here's what that pattern actually is. It's compression. Sellers running out of supply. The stock getting tighter and tighter, wound up like a spring. And the breakout candle, the one on earnings day, did 3 things simultaneously that I want you to remember. Number 1, volume. 5 times the 30-day average. I'll say it again. 5 times. That is not retail traders punching in market orders on Robinhood. That is systematic institutional buying. That is funds that manage billions of dollars deciding in unison that this stock is mispriced and they want to own it. Number 2, the price broke cleanly above the upper trend line of that 8-month descending wedge. Not a test, not a wick, a close above. Textbook breakout confirmation. Number 3, relative strength versus the S&P 500 turned positive for the first time since last September. The stock stopped underperforming the index and started leading it. That is the signal that tells you this isn't just a stock-specific pop. It's the beginning of a repricing cycle. When all 3 of those things line up at the same time, volume confirmation, technical breakout, relative strength turn, the historical probability of continuation over the following 30 days is above 70%. That's not a guarantee, but it's a meaningful edge. Now, here's where I need to pump the brakes. Because everything I just told you sounds great, and it is. But the risk in this trade right now is real, and I'd be doing you a disservice if I didn't walk through it. Short interest. As of the most recent settlement data, 18% of Sprinklr's float is sold short. That means roughly 1 in 5 shares that exist is owned by someone who is betting this stock goes down. Now, when a heavily shorted stock starts moving up fast, on strong volume, on a fundamental catalyst, those short sellers start losing money, and at some point, they have to buy shares to cover their position and cut their losses. That buying pressure adds fuel to the move. That's a short squeeze. Short squeezes can be violent. Stocks can go up 50, 60, 80% in a matter of days during a squeeze. That sounds exciting. And I know what you're thinking. But here's the thing about short squeezes. They end, usually without warning. And the people who bought in late, who saw the green candles and couldn't resist, are the ones holding the bag when the squeeze reverses. The real question right now is not whether Sprinklr goes higher. It might. The fundamentals support it. The real question is, what is your exit if it doesn't? What is the level where the trade is broken? What is the maximum drawdown you can absorb before you close the position? Have you sized this position appropriately relative to your total portfolio? Most retail traders do not ask those questions. They see a green candle, they feel the fear of missing out, and they buy at market. That is not trading. That is speculation. And speculation without a defined exit is just gambling with extra steps. Let me zoom out and tell you why this particular move matters beyond just Sprinklr. For the last 18 months, the market narrative has been dominated by one theme: artificial intelligence, mega-cap tech, the Magnificent Seven. And those names ran hard, for good reasons in many cases. But valuations followed the price up. Some of these companies are now trading at 50, 60, even 80 times forward earnings. Those multiples assume perfect execution, perfect macro environment, perfect competitive positioning for years. That doesn't mean they go down, but it does mean the margin of safety is thin. Meanwhile, mid-cap earnings, growth, companies with market caps between $2 billion and $10 billion is now outpacing large-cap earnings growth for the first time since 2022. These companies are leaner. They benefit more from falling interest rates. They have more room to expand margins. And institutional money is starting to notice. When a $50 billion fund needs to rotate out of stretched valuations and into earnings growth, it can't buy large-cap names without moving the market against itself. It has to go to mid-caps. Quietly. Over weeks and months. The Sprinklr move is a data point. One data point does not make a trend. But when I look at my scanner right now, I'm seeing similar setups: descending wedge compressions, relative strength turning, volume building, in a dozen mid-cap names across software, healthcare, and industrials. That is not a coincidence. That is rotation. The question I want to leave you with is not whether Sprinklr is a buy right now. That depends on your entry price, your risk tolerance, your time horizon, and about 20 other variables specific to your situation. The question is, are you paying attention to the right part of the market? Let me bring this together. A mid-cap stock just went up 40% in 14 trading days. The fundamental catalyst was a 300% surge in free cash flow. The technical setup, a descending wedge breakout with 5 times average volume and a relative strength inflection, was identifiable before the move was complete. The risk is real. 18% short interest means volatility in both directions. Anyone buying here needs a defined exit, not just hope. And the bigger picture says this isn't isolated. Mid-cap rotation is early. The setups are multiplying. The skill isn't finding the stock that already moved 40%. The skill is spotting the next one before it does. Every Tuesday and Friday, I break down exactly what I'm watching. The scanners, the filters, the specific price levels I'm tracking. No noise, just the setups. If that's useful to you, subscribe. Hit the bell so you don't miss a post. I'm Marcus. This is Black Bear Trading. See you Friday.